Hi, my name is Josh Freeman. I am an attorney with the law firm Freeman Lovell. We are an entrepreneur focused law firm that helps entrepreneurs and small business owners take their business from idea to exit. Our hope is to help them understand and take the right risks while they go through the processes of structuring, scaling, and selling their businesses. We put together this program from idea to exit to help provide information and understanding and training on the different issues that small businesses and entrepreneurs are going to be faced with and need to deal with. And so this first section we're talking about is choosing an entity, choosing the right entity structure for your business. Our previous video, we did a deep dive into what LLCs are about and some of the pros and cons and benefits there. Today, we're going to talk about the second most popular entity type, the C-Corp. So the C-Corp, we like to refer to as the OG. They're kind of the original gangster when it comes to liability protected entities. So, it started out with partnerships where the partners were just liable for all of their contracts and everything personally. So if a business deal went bad, they lose their house. Business owners didn't like that. Then the governments created the C Corporation. And so the C Corporation was a way to allow businesses to engage in business and make large contracts, make deals that an individual wouldn't want to make if their home was at risk or if their personal assets were at risk. And so that's where it came from. The C Corp, unlike the LLC, has only one taxation type. It's just the C Corp taxation type. So there's not the flexibility, there's not the options and elections that come with the LLC. Now, talking through some of the pros here, there's a lot of equity flexibility that comes with the C Corp. You can have multiple classes of stock. You can have voting, non-voting stock. You have preferred shares and common shares and common voting shares, common non-voting shares, and preferred voting, preferred non-voting. And you can have multiple classes of voting shares. You can do a lot of different things that way. And so there's a lot of equity flexibility and can be used that way. It's also really beneficial if you're looking to take your entity to an IPO, because C Corp is the entity type that goes into that direction. It's also a really popular it's really popular type for investment transactions. With especially for like high growth technology startups and entities like that. Large venture capital firms and others will look favorably on an entity that's formed as a C Corp because they're easy to invest in. The document packages are more simple, and the growth and the compensation with equity and other things like that is more simple. And so that kind of leads right into that employee equity incentive plans. So with the C Corp, it's very easy to set up, stock option plans, that have a lot of different flexibilities and have other favorable tax benefits associated with those as well. So it's C Corps are good entities if you're planning on using a lot of equity to compensate, other employees or partners or things within your entity. And then another pro that pushes a lot of people into the world of C Corps is the ability for a C Corp to qualify under the qualified small business stock program. Basically, what that is if you qualify, you can essentially save up to the greater of $10 million in capital gains, or 10 times your adjusted basis in the stock at a capital gains event. So if when you're setting up the entity, if your planned exit for your ownership is somewhere around $10 million, somewhere up to $10 million, then qualified small business stock could be really valuable to you. Or if you're investing a lot in the business, if a venture capital investor puts 1.5 million in the business, he gets 10x that basis in sales price. So he could sell his for 16.5 million and save all capital gains on that. And so that can be a really big savings, because 20% of 16.5 million is what's that, three, I can't do that math, but yeah, it's a lot of money. One of the cons, though, is if the company gets too big, then to make this election, you would end up having to pay higher capital gains rates. You paid a 28% capital gains rate instead of a lower long-term capital gains rate on amounts above that 10 million savings or above your limit. So there's that con. But for businesses that can qualify, here are the basic requirements. The investor, the stock owner, has to hold the stock for 5 years to qualify. It needs to be originally issued stock, so that means that it can't be sold from another owner. It needs to be sold directly from the corporation. The investor can't be a corporation itself, so it needs to be an individual, an LLC, another entity type. The stock needs to be purchased with property or with cash, or it can also be granted as payment for services. So there's some flexibility there. And then the business entity itself has to have 80% of its assets, being used in a qualifying trade or business. So there's some requirements there that have to happen, but this can be a really tax advantageous thing for businesses. So some of the cons with the C-Corp structure is double taxation is one of the big cons. And so to kind of give you an example of what that means is, so if a corporation does business for a year, has a very good year, they're profitable, make $1 million, for example, then the corporation itself has to pay 21% tax on those profits to the IRS. So right off the top, you take off $210,000 of that $1 million, give that to the IRS. Then let's assume here that the corporation decides to pay the rest of that money out in dividends to the owners. If all of those owners have a 35% tax rate, then they're going to end up paying $276,000 in taxes and end up at the end of the day with only $514,000 between all of them. So compare that to a pass-through entity where there isn't tax at the entity level. In this case, the owners of the business would have made $136,000 more. They would have made $650,000 that year rather than only $514,000. So in a situation in a company where the dividends are being paid out on profits every year, this structure may not be the best for the business as far as tax reasons. But let's look at another example, because it's not always the case that double tax is a bad thing. Because with the tax rate being only 21%, there are situations where if you have a corporation and the owners are in high tax brackets, higher than the 21%, and the corporation is retaining those earnings and not paying them out as dividends, then it may be tax advantageous to be a C corporation and only pay at the 21% tax instead of paying at each individual's pass-through tax rate. And so, I need to go back one more. There we go. So basically what that means is that with the corporation, if you're retaining those earnings and you're going to spend them in the corporation, if you don't have pass-through tax, you keep $790,000 in the business. However, if you are paying pass-through tax, then you're going to have to give your owners $350,000 to cover their taxes. And so that's, so there's kind of the counterpoint to that. So if you're a business that's retaining a lot of earnings and not paying dividends to, and if your owners are high tax bracket individuals, then it could be a tax win to keep it that way. And then the next point is another con of the C Corp is that there's no pass-through losses. So what that means is, say your company operates in the year and your expenses exceed your revenues, and let's say your corporation loses $500,000. What that means is that your corporation then logs $500,000 of loss on its books that will counter against future earned profits. So if the next year you had $250,000 in profits, you'd still have, $250,000 of losses to use in future years. But none of this money transfers down to the owner. One of the problems with this is if you lose money and then the company goes out of business, and then the owners won't be able to take advantage of, those losses on the business. And so that's one of the problems with the corporation. Whereas with a pass-through entity, if you have $500,000 of losses in your LLC taxed as a partnership that's a pass-through, then the LLC every year passes all those losses through to the owners, which means each owner then themselves has that $500,000 to use on their personal tax returns. So if I had, a $500,000 loss, but I made $500,000 from another business or from my job, then I wouldn't be paying taxes that year because they would offset, assuming they're within the same class of gains and losses. But kind of like, that's the concept. So another con for C corporations is with regards to the formalities. So to keep the liability protection so that a creditor of the corporation couldn't come after an owner's home or cars or whatever it may be, they have to follow certain formalities. And basically what that means is, they have to keep a board of directors, and reelect and appoint them and have annual meetings of boards of directors every year. You need to have the annual meetings of the shareholders, and you need to follow those formalities in making decisions and appointing officers and doing all of those things. And so it's a little more complicated, and there's some issues that can come up if you get sued and you haven't been following those. Then there may be a claim that you've lost your liability protection and that the owners are on the hook for what the company owes to its creditors. So that's one of the other cons. Now just getting to kind of like the ideal candidate. So the C Corp, kind of like we talked about in previous videos, kind of the higher risk, higher cost, higher return type entity. And so, with that kind of framework, C Corps are, great entities for kind of the high growth startups that's looking to attract, top national venture capital firms to fund their growth. And they're going to be growing very rapidly and moving towards doing an IPO. So that's probably the place where they're used the most. And then they're also used for those businesses who are looking to qualify for this qualified small business stock, capital gains tax exemption. And, and so those are kind of the two places where it makes sense to use the C Corp, and where it really outweighs the flexibility benefits of the LLC. But thank you for spending some time with me, listening to this. Hopefully you learned something. Again, my name is Josh Freeman. I am with the law firm Freeman and Lovell, and we're here to help you entrepreneurs and small businesses do what you need to do with your business to take it from idea to exit. Again, thank you. If you want to contact me, my contact information is on this slide, as well as you can track me down on our website. But again, thank you.